I met Shawn there, great guy. He was part of our sponsor panel conversation about trust and advanced planning concepts. So he's going to touch on that as well as Dunham strategies and even maybe a little highlight of donor advised funds as well. So, Shawn, with that, the floor is yours.
Oh, thank you, Sebastian, and thanks everybody for your time today. Again, I know I met some of you in Hershey. Just really enjoyed that meeting and the partnership I've been developing with Premier and many of the advisors here at the Premier Group. So thank you all again. And just to introduce myself, and for some of you that haven't met me, I'm the regional sales director for our Mid-Atlantic. Should encompass a good bit of this group, cover Pennsylvania, New Jersey, Maryland, Virginia, and Delaware. We have regional directors in other areas if you are in those other regions, but I'm certainly glad to help you and steer you in the right direction. And I've been in the industry for about 23 years now. I've been with the firm with Dunham and Associates Asset Management and Trust Company, going into my sixth year now. And I really I have a 6 and a 4 year old boy, very passionate about them. Outside of work, really big primary focus of my life. And big Philadelphia area sport or Philadelphia sports fan. So if anyone ever wanted to chat some Philly sports or Penn State, be glad to have those conversations. But really, what I wanted to discuss with you all today is raising assets. So something I'm very passionate about is helping bringing incremental revenue to financial advisors I work with in their practices. And at Dunham and Associates, um, we we do a lot of things that are unique and different because we're a trust and asset management company, which is quite different and something that attracted me to this firm when I was looking for a new step in my career. Just the idea of being able to help advisors and their clients, not only with asset management but also trust and intergenerational planning and just some unique things that could really lead to significant assets. And there's some of the concepts we're going to talk about today. And so I'm going to a few things I'm going to touch on, and I should be through this in about 3 hours. So hopefully that works for everybody. Now we're going to be 25 minutes. And if people have questions, I'll stop a few times, or certainly you could ask as we go along, as well, if anyone has any questions for me or wants to discuss any specific scenarios. But yeah, on the screen here, you see I'm going to talk about Dunham DC. That's how we're managing money at Dunham, really our best thinking. I think you'll find it unique and differentiating. We're going to discuss charitable remainder trust. I'm going to talk about non-qualified charitable remainder trust, but we also do charitable remainder trust on retirement accounts if you're interested in learning more about that. And also, we're going to discuss being exit planning and getting a front row to win large AUM through liquidity events. You'll see how that could be quite unique and different, and something that almost every advisor I talk to about has some opportunity there. So, and then if we have some time, I'm going to touch on donor advised funds because we offer a really nice donor advised fund at Dunham. And as many of you may be aware, it may not be as advantageous for your charitable donations next year from a tax perspective with some of the big, beautiful bill tax law changes. So it might make sense to get some of those charitable donations in this year. So on exit planning being in the front row seat to large AUM. So what I mean by that is just getting you in front of large pools of assets to manage through this trust type strategy. And the strategy is called an intermediated installment sale trust. Um, and this is a really unique type of trust that at Dunham Trust Company, we're willing to trustee this type of trust. And the reason I say that is because not a lot of trust companies offer to trustee these types of trust, and you really need a corporate trustee under some of the laws and tax regulations on one of these types of trusts to really keep this above board with the IRS, and needing a corporate trustee. And we are willing to corporate trustee and help you and shepherd you through winning these cases and types of business. So what is an intermediated installment sale trust? Um, it is so if any of you have people that are selling businesses or real estate, um, that have low basis. And almost every financial advisor I talk to says, you know what, I know somebody with that, or that's a client of mine or a prospect. So if you don't have anyone currently, keep this in mind, keep it in your toolkit. And also keep it in mind as you're having conversations with people. I know we're getting into the holidays and a lot of us will be doing socializing and networking. So an intermediated installment sale trust is a trust that can sit in the middle of the deal of the people selling businesses or real estate, um, that they could sell the asset to them, that buyer, through this trust, and the assets would go into the trust, and your client or prospect can defer the capital gains tax from that sale for as long as 20 years. It could be less, but if they want to maximize the capital gains tax deferral benefit, that 20-year time frame is optimal to do that, and that is where we would be comfortable with from an IRS perspective. So the money from the sale, we have you manage it. So you've gotten large, sticky AUM, back to my point on my other slide, to manage for at least 20 years inside of that portfolio. My ask is that you would consider some Dunman asset management for the portfolio for helping you through that process and helping you win that business. We are a non-proprietary trust company, so not required. But again, that is an ask of mine for helping you with that business, and keep that in mind for other trust scenarios or situations where if you have us trustee, we keep you on to manage the money opposed to some of your competitors out there. So that money is now sitting inside of that trust, and that client is deferring that capital gain for as long as 20 years. And we can work with you to get them back out an income stream from that money. So what you've essentially done is taken an asset, which was a tremendous amount of work, liability, and responsibility, and got it into a well-diversified portfolio with you as the asset manager collecting a fee on that, and kicking them back out passive income where they don't have to do anything. And that's where a lot of these people are looking to downsize these businesses, this real estate, get a lot of that liability and responsibility off of them, get passive income, but they're concerned about paying the capital gains taxes if they sell the business or real estate. So it's really a neat, unique solution that I don't know of a lot of other trust companies that offer, again, to trustee on these and help advisors and guide them through these cases to help them win large AUM. If you guys have anybody in mind for one of these, just call me, let me know. I'm working on these cases every single week here at the firm. We can run some numbers to see if they make sense. The numbers are generally very compelling, and I can guide you through the next steps in the process to help you win this business. We actually had a question, which was great. Someone did a
Yeah, Sean. Hey,
yes,
Sean. How does this differ from like a 1031 exchange?
yeah. Thank you for the question, Josh. Excuse me. Yeah, so a 1031 exchange is an option, another option on for real estate sales to defer capital gains, as I'm sure you all are aware. In a 1031, though, people are going back into some kind of real estate, whether it's a like property, maybe a REIT product, things like that. Within this option, the proceeds from the sale are invested in a well-diversified managed account portfolio with you as the financial advisor on there. So a lot of people like this better because they don't necessarily want to go back into real estate investments. They could be risky. They could still be more liability responsibility that they want to get out from under. So that would be one of the one of the primary differences. But that is certainly an option on real estate, and that is under the same tax code as an intermediated installment sale, tax code 453. And then the other thing a big difference is this works for businesses. 1031s would not work for businesses. And there's not a lot of options out there for people that are selling businesses to defer capital gains taxes.
Thank you.
Oh, yeah, you're welcome. Any other questions on an intermediated installment sale trust?
Yeah, I have a question.
Oh, sure, Charles. Yeah, good to see you again.
To see you. So
Yeah.
typically, when a trust grants you this massive tax deferral, aren't there issues with incidents of ownership that you cannot show incidents of ownership? And if that's true, and you're taking out a monthly income stream, then you do have some control over the disposition of the principal and so on. So am I just way off base that none of this matters, or is there some sort of trickery, circumvention of some aspect of the tax laws that allows you to be granted this tax deferral for 20 years?
Yeah, no, you're right on some of like what you're saying, Charles. So that is where we come in as a corporate trustee. So the IRS wants to see some arm's length here because if you or I took constructive receipt of the money, right, and we're drawing income off it, we would owe capital gains taxes, right? And that's where the trust sits in the middle and we act as a corporate trustee. So in that trust document, it is written, and I don't want to get too into the weeds there, but the client does not have complete control of that money for that life of that trust. Now, granted, they're getting an income stream, and that's written into the trust document. But us as corporate trustee would have control of the trust during the life of it. So, say the grantor, for instance, wanted to dissolve the trust early, they technically would have to come to us and ask us to do that. If the income stream, say it's 5% coming out of there, they want to increase or decrease that income stream, they would come to us as a trustee and we would increase or decrease that. But there is some level of arm's length there where it's not technically their money for the life of the trust. And that's what makes it allowable under the IRS code. The some things that make clients comfortable with that is that the money is invested through a Cambridge account. And again, I would ask that you set up a Cambridge account
Yeah.
and put some of it in Dunman Asset Management. But that creates delineation of the assets, and that's the collateral of the trust. That there's some segregation there when they're losing a little bit of control on that money. And it is an asset that is still technically an asset of theirs, this trust, that comes back to them when the trust dissolves, whenever that is, if it's in 10 years, 15 years, or 20 years. And that's why the IRS makes this an allowable tax strategy.
But if the client is taking some out as, monthly payments, as if it's a note or something, then surely there's some proration of that monthly payment that has to claws back some of the capital gains tax.
Yes, so on most of these that we establish, the if the clients are taking at a reasonable level, like an IFR type level of income, let's call it 4 or 5%, that actually just comes out as ordinary income. So the full capital gains tax at that point would be deferred. Now, if the client wanted to take 9, 10% out a year, some of that would come out as income and capital gains along the way. But most people keep it in that 4 to 5 range on income, and they're simply deferring that cap gain for the whole time frame and just paying ordinary income on that
Okay.
money coming out of there. The neat thing about these is there is a lot of flexibility how the document can be structured if you wanted to just draw income, if you wanted to play some capital gains along the way, if you wanted to do it for a shorter time frame. There's a lot of little differences or nuances these can be structured, which is neat because they're not cookie cutter, right? A lot of other solutions would be very like cut or dry, like here it is, take it or leave it. And we can certainly help shepherd, you and your clients through this whole process. We've been offering these for close to 7 years now. We have several hundred on our books. We've gotten these down really well at Dunham.
Okay. Thank you.
Yeah. Anybody else? Well, great. No, thanks for the questions. I appreciate it. And So on my next concept I wanted to talk about was Dunham DC, how we're managing money at Dunham. So I mentioned to y'all we're an asset manager as well. Um, our best thinking and how we've been running money and we've been running money for over 40 years at Dunham. And I'll talk about that in a little bit more detail. But we implemented an overlay on our existing portfolios. Then we won an award. We were nominated for an award on this, which simply follows some philosophies of someone we all probably know, we all know very well, which was Warren Buffett. And the approach is just to be fearful when others are greedy and greedy when others are fearful. Pretty basic premise, one of the greatest investors in US history. I recently heard he's taken a little bit of a step back. Not sure if everybody saw that. And a lot of our marketing around this Warren or talks about Warren Buffett, and people really like Warren Buffett, other than I heard his kids, because apparently he's not leaving them any money, but I do think that they might be okay. And Buffett was influenced by Benjamin Graham, and our chief investment officer that designed this asset management process that I'm going to talk to you about was really influenced by Benjamin Graham and Warren Buffett in this process of being greedy when others are fearful and fearful when others are greedy. Has anyone ever, if anyone's ever read The Intelligent Investor, just a great book on Benjamin Graham and his findings. I highly recommend it. And so the goal of Dunham DC and our asset management process is mitigation of sequence risk. One of the biggest risks out there for that retiree, that risk-averse person, putting too much money into equities at the wrong time when markets are high, just like, a week or two ago, right? When we're hitting all-time highs on equities and, putting that 60% into equities. If that market drops like an elevator, like we've seen it do, over the last couple downturns, and people take money out of there, that is sequence risk. That could be a huge risk to the retiree, and that's what we're trying to reduce here. And with that increasing accelerating recovery time inside of portfolios, and we wanted to take emotion out of this of investing and buying low and selling high. A lot of emotion can come into that, and we have a process where it's just simply using math, so it takes a lot of emotion out of that process. And we have different models inside of our programs that I'll show you here, where depending on the person, we can get them into a different model. And just to take a step back on our asset management process, these are our strategic models. So we're a strategic asset allocator and an asset manager at our core, and we've been running these strategic models for over 20 years. We have over a 20-year track record on these, and we're very proud of that. And just to give you a couple of quick highlights, like from January 2022 until September of 2025, our fixed income was cumulatively positive over 3%, whereas the ag was still negative. If anyone didn't know that from that downturn in 2022. In 2022 on fixed income, we were down a little bit more than 4, but the ag was down close to 14. So really, we've done a really nice job in these models. And just to touch on one thing in fixed income, and I know Sebastian's used our international fund, and I think a few others of you have as well. On the international side, we've done a really nice job. Our international manager won a 5-year Lipper Award for performance. We're up over 43% this year. So some of our underlying asset classes have done really well on our strategic models. But our chief investment officer thought he could do better inside of portfolios. In our strategic models, we make adjustments and we rebalance quarterly. So you're in a 60-40, you come back to 60-40, which is great. We have a really good track record of that, and we've added some alpha and downside protection through those adjustments inside of the portfolio. But Ryan, and our chief investment officer, thought he could do better. So he wanted to develop an approach like Buffett and Benjamin Graham, where he bought more equities when the market's down and sold fixed income, and when the market came back up, he sold equities and bought more fixed income. But his challenge was that at some point he would run out of equities, right, or run out of fixed income, and because the markets tend to go up more than they come down. So he kind of tabled the project, and then eventually he developed this curve, which we ended up calling the Dykman's curve. Ryan Dykman's is our chief investment officer. And what the curve does is it shifted up. It gave it a time element. So we wouldn't run out of equities or run out of fixed income in the portfolios. So we became comfortable with this process, and we launched Dunham DC in November of 2022. And what it simply is an overlay on our existing portfolios that we ran for over 20 years, our models, where we sell high and buy low inside of portfolios. And what I'm showing you here on this chart is when we launched our first portfolio, or we got a composite portfolio into this in November of 2022, this is a 60/40 global version of this Dunham DC. What I'm showing you here is our algorithm had us buy 53% equities. And then the market dropped. So we bought 7% more equities and sold fixed income, and we went to 60/40 inside of the portfolio. And if you follow along here, you'll continue to see the reds are sells and the greens are buys along the way as we follow along 3 years through this. And I'll just show you a really good example here was when Trump made the tariff announcement, our 60/40 version of this was in 33% equities. Well, as everyone knows, the market went down like an elevator. Well, within 2 days, we bought more equities twice. So 7% equities the one day, another 7% equities the next day. And then, as we all know, the market came back. So we bought those equities cheaper, turned around and sold them back to the market at higher multiples and prices that people were willing to pay. So getting back to it, it's a sell high, buy low strategy overlay that we've implemented on our portfolios, and we'll have a 3-year track record on this next month. And you will see here, we are risk off on equities right now. We've sold a lot of equities into this high market. We've all seen a little bit of a pullback here. If we see a little bit more, we'll be able to buy more equities on sale cheaper. So if you think about eliminating some of those things I talked about, like sequence risk for some of those investors, they also need to keep up with inflation, though, where the inflationary numbers are. And they need equities to do that, but owning them at the wrong time could certainly be detrimental. And then just one more thing we were thinking about with this is people are living longer lives, not only longer, but healthier lives. So they need to keep up in their portfolios to support those longer, healthier lives. And then what I would show you is these are the different models I mentioned. So we have a 60/40 version here. We also have an 80/20 version. And these are the ranges of equities and fixed income we could own. And then we have a 40/60 and a 20/80. These are global models that incorporate international, which again has done really well in the portfolios. About a year and a half ago, we launched a US version because we had advisors asking for a US version. So 4 more models that would have more of a US approach to them. And then you see here's some performance numbers. The numbers have been very competitive. What I really like to look at and think about is, especially for that more risk averse, that retiree, you'll see here the max drawdown on this has been about 350 basis points lower, or 37%, which could be crucial for people if they're taking withdrawals, maybe need money for roof, want to take that cruise, daughter's wedding type of thing. If we can reduce their downside, that might really help guide them through retirement, or they're just simply investing for whatever their goals and objectives are. I will stop there and see if anybody had any questions for me on Dunham DC. If anybody is interested in getting more information, let me know. I can run a proposal on any of these. So just need to know client name, dollar amount, what you want to charge for your fee. Our fee to utilize these is 25 basis points. And these are directly held Dunham accounts, which are really easy to set up. We've created tremendous scale from an operational perspective. And I think someone had a question, though, so
I was just going to say or ask, these funds can or cannot be purchased on the Schwab platform.
Yes. So our Dunham DC and our managed accounts would not be available there. They would be a direct relationship with Dunham to open one of these accounts. We do actually offer 15 mutual funds. That would be the underlying holdings inside of these portfolios, Charles, and the 15 funds are available through the Schwab platform.
Got
And
it.
I could share that. We could share that. I could share that list with you if you wanted to take a look at any of them. I think we had another question. Somebody might have raised their hand. Oh yeah, Jim. Hey Jim. Thank you.
Hey, just quick. Maybe I missed it, and I should know this already, but never thought to ask. Is there a trigger point for, is there a percentage trigger point for whenever Ryan decides to let go of 5 or 10 or 7% or some of the number talking about it versus and then another trigger point for buying back in?
Yeah, so the algorithm doesn't have a defined like percentage where we'll buy and sell, but what I notice is it's somewhere between 4 and 7% range, and that time element adjusting kind of moves that range. But um, I could almost set my watch to if the market's up or down 5%, I'm going to see a buy or sell. As I've been following this, for 3 years, I think we placed like 26 trades. So that would be kind of a guiding post to get you pretty close to that number.
Okay.
And it's really
Thanks.
neat when we buy or sell, people that are invested in this, advisors get an email, but their clients actually get one. And the feedback on those emails has been really tremendous. Right.
But the clients are getting them too?
Yes.
Okay. Surprised no one's asked me.
Yeah.
I don't know what they're reading. I'll have to circle back on some of my clients to figure out if they any questions about that. Good to know. Thanks.
Okay. Yeah, we could certainly talk about that as well. I know you have some people in this, Jim, so thank you. I appreciate that.
Sure.
Yeah. And hopefully everyone's okay on time. I know I promised you under that 3 hours. I know I'm pushing it about 30, so probably be about 5 minutes or so though. I'll go through charitable remainder trust and then maybe see if there's any other questions. But charitable remainder trust is, I'm sure most of you are familiar with charitable remainder trust. I believe they've been around
Yeah.
since the 60s. Maybe you've implemented some. We do a lot of work in this space. And just to go over some of the advantages, could eliminate capital gains taxes at the point of sale, give the clients a really nice tax deduction, provide some income, provide flexible income for those clients. So it could be a minimum number going out to them, a maximum number. Get them some diversification. I have one where I'm working on right now where the client and the wife have about 80 to 90% of their money in one stock, Sherwin-Williams. I'm sure they're a good paint company, but we're helping them diversify through a charitable remainder trust. If people have an estate tax issue, it would remove the assets from the estate. And then also whatever's left in a charitable remainder trust would go to a donor advised fund or a charity. I have a case study here. This one's an $8 million opportunity, and maybe you're coming into them or maybe you will, but keep in mind a charitable remainder trust that we work on, you'd probably be looking for about $500,000 in gain for this to make sense. So that would be more of your middle to upper middle Americans, probably have something like more in that range. So keep that in mind. But on this case, the person had an $8 million equity position with an $871,000 cost basis. So with this case, and this is these numbers are round a little bit, but something that we did work on and get this business. So the $8 million had a cost basis of 871,000, and there would have been a gain of seven. I'm sorry, there was a gain of 7.182 million, and selling it through the charitable remainder trust. What it did was it created lifetime income for the person, or it could be for a couple. So these can be set up second to die. A lot of these I work on are for married couples. And then what was left went to either a charity or we offer a donor advised fund. So we would maybe suggest naming that. There's a couple reasons why you would do that, and we could talk about that a little bit more offline here. But the assets fall into the charitable remainder trust. We eliminated 2.195 in capital gains tax at the point of sale. There was an immediate tax deduction for this person of 3.7 million. That can be taken over 5 years, so it might not all make sense year one. And we are assuming a 6% distribution from this CRT. Some of these cases, there's a minimum 5%. We see in some instances a lot higher. Like when I mentioned that Sherwin-Williams case, that couple's taken out 11.34. And that's actuarially based. And we have a software that can calculate all these numbers that really showed it.
That seems high to me. I mean, if you pick a higher payout rate, then the present value of your future gift goes down. And you're talking about a 6% payout and a tax deduction equal to, 40% of the amount that went in. That seems high. And then even still, if you've got that big tax deduction and you're limited to 30% of your AGI to take that deduction, then you need to spread that tax deduction over more than 5 or 6 years.
Yeah, and you're right, Charles. So in some examples, like people take more. So if they're taking more income, they get a lower tax deduction. I think in this case, the person was more charitably inclined and they didn't take the higher deduction. I'm sorry, the higher income payment out of there. So more was going to the charity. And you could see in some of the other numbers I run where we might have a better opportunity to have all that deducted over that 5-year time frame. Yeah, so in this example, though, we eliminated 2.195 at the point of sale. So this is tax deferral over the life of the trust, not tax elimination. Again, there's that high tax deduction. And then over the 6 million after tax, and the client got over 6 million in after tax income over 19 years. They were in a pretty high tax bracket. As you could imagine, something on a case or a study this high. And then over close to $8 million went to the donor advised fund. But in this case study, the client wanted to leave something for their 2 children to inherit. These charitable remainder trusts can lead to life insurance sales. Does anybody sell life insurance out there? I'm sure most of you do, or wouldn't turn down a life insurance sale. What we show here is some of that capital gains tax deduction that the person had. They utilize some of that to fund a life insurance policy. And also maybe some of that, they could use some of that income. In some cases, they may or may not need an ILET. In this example, is a pretty high net worth client. People may or may not need an ILET, but that's something we could certainly help out with at Dunman. And then the family ends up getting the most tax efficient asset, which is that life insurance policy, a great way to pass down money to clients. And I'll stop there and see if anybody had any other questions. If you have a CRT opportunity, I would just need to know either the value of the stock or the amount of shares in the stock. And if you had the cost basis and the state that people live in. And we could run an illustration that would show the minimum amount they could take, the maximum amount, those tax deductions under those different levels, and the amount of income they would have coming back out to them. And then, again, you could diversify the client into a well-diversified portfolio. Our ask is you would consider some Dunman for that portfolio. And that's a big thing to think about with these, is that single stock risk, right? That one family I mentioned that has that Sherwin-Williams. We're looking at $1 million on a sale of selling $1 million of that. They actually have like 3.2 million. It was a gift, so they didn't get the step up in basis on that. So certainly consider and send us over those opportunities. And looks like I have a question coming in from Paul.
Yeah, hi, Shawn. Nice presentation. Quick question. So does Dunman work with the estate attorney in terms of the drafting of the documents, or is it primarily the strategy and the asset management, which becomes part of the estate planning, and the actual drafting is done, of course, by the attorney, I guess? I'm just trying to understand where Dunman fits in as part of the whole process.
No, that's a good question, Paul. So yeah, we can do a lot of the upfront work, like the illustrating, presentation work with you, stuff like that. We could trustee the trust. If they wanted to use a corporate trustee, we would highly suggest it on these. Okay. You would manage the AUM, and as far as drafting the document, we may or may not be able to draft it. It's kind of a case by case basis. So we could certainly talk about that if you have a particular case. Some people do use an outside attorney. In some of these cases, though, we may be willing to draft that document at a generally a significantly lower cost to the client.
Okay, thank you.
Sure, thank you. Yeah. Anyone else have any other questions or things for me?
Are most of the charitable trusts done on a unit trust basis or an annuity trust basis?
You could do either one. Our software will show both. Charles,
Right,
I
I'm
tend to
asking
find a
you
lot of people
what-
doing the unit version,
Yeah.
but I think the annuity one might make sense if you're doing some significant financial planning and you want to show them like a certain dollar amount coming out to meet like income needs or part of that financial plan. So you could go either route. Yeah. We can do some other cool things like flip crut, where you don't
Yeah.
take the income for like 8-10 years, if anyone's heard of that. So we do a lot of neat things on those, and there's a lot of different options. But we can help you navigate all that and come up with different choices.
Okay.
Yeah. Anybody anything else for me?
Did you want to go over donor advised funds? I mean, we do have 20 minutes blocked off here. I don't know if you feel like the CRT convo kind of touched on enough of that, but you do have 20 minutes if you want to take up a little more time.
Oh, I appreciate that, Sebastian. Yeah, I forgot. So thanks for jolting my memory there. I appreciate that. Sometimes I need that. Yeah, so we offer a donor advised fund at Dunham, and it's that time of year, where people might want to think about donor advised funds because and especially this year, because as part of the Big Beautiful Bill Act, and I'm sure many of you are familiar with it or read it, but your charitable donations next year aren't going to be advantageous. So like there's what we call, and I could send anyone wants to see, we have a nice piece we wrote on this called a shave and a haircut, right? Next year, your charitable donations, there's going to be 0.5% come off of your AGI before any of your donations are deductible. So let's just use an example of if somebody made $200,000 and they're giving away $5,000 a year, 1,000 of that will not be deductible next year. So that 1,000 will come off, which is at half of 1%. With that tax law change. And then if people are in the highest tax bracket, the 37% Fed tax bracket, they'll only be able to deduct 35% of those donations opposed to 37%. So there's two tax law changes that do not make charitable donations as advantageous. So if you have anybody, you talk to that is doing charitable donating, there's a chance some of that money's not with you. It might be a good chance to get them to put some monies into a donor advised fund, and we can help with that. We have a great solution, and get you some AUM and help them out from a tax advantage standpoint. And if anyone's not familiar with the donor advised fund, it's just simply a way to put money into an account where it counts as a charitable donation this year, but you don't have to give it all away this year. So you could put it into there, get the tax deduction in 2025. The money's invested with you as a financial advisor. You collect a fee on it, and clients can give it away to charity when and however they want. We have a really nice donor advised fund with an online portal that makes donating very easy, and it tracks all those donations through a nice statement. And don't just think of your higher net worth clients, like, maybe go out to them and explain that tax law change and see if you could get them to bunch some money. And that concept of bunching would be taking multiple years of charitable donations and putting them into a donor advised fund this year to take advantage of those tax law changes. And think about if maybe you don't think some of your clients are giving money away to charity, maybe you just don't know. It's a good question just to ask people. Might help you pick up some AUM. I find people come back to me and say, well, I never really asked my clients, but I realized they're giving away more money to charity than I thought. And we've ended up setting up donor advised funds. And they can also be for middle Americans as well. So don't just count out. They just don't think they're only for really high net worth people. Paul, you have a question?
Yeah, so a quick question on donor advised funds. Would the client have any say in terms of the charity that they want to support? Um, or it's the fund has a pre-listed set of charities?
Yeah, that's a great question, Paul. I'm glad you asked that because I didn't bring that up. Yeah, no, our donor advised fund, people can give the money away to whatever charity they want. Like right on our portal right now, there's hundreds of thousands of charities. And if something's not on there, they could get that charity added pretty easily as long as they're a 501(c)(3). So you do bring up a good point, and I tend to forget that some donor advised funds, they decide how to give away the money, not the person that donate it. So it is a nice advantage of ours is that the person, would pick that particular charity. And then another thing is that some donor advised funds, a financial advisor cannot collect a fee on. On ours, you can get compensated on our donor advised fund.
And just a quick follow-up that if a client has previously set up a charitable remainder trust, let's say last tax year in 24, they can still utilize that in 25 before the tax law changes next year, you're saying, and they could use it either in their existing trust, or they could set up a new donor advised fund. Would that be correct?
That is correct. Yes.
Okay.
Yeah.
All right. Thank you.
You're welcome. Yeah. Anybody else?
Yeah, Shawn, it's Jim again.
Oh yeah, thanks, Jim.
What's the minimum for a donor advised fund?
Yeah, so our minimum would be $50,000.
Okay.
We would accept one below the minimum. There would just be a small account fee every year. I think it's like $65 below the minimum. That might be a number though, like 50 grand, where somebody could take advantage of a concept I mentioned called bunching your charitable donations. So say you have somebody giving away 10 grand a year. If they take the standard deduction, they may still fall under where the accountant just takes the standard deduction with that 10 grand a year. But if you took 5 years of donations and put them into a donor advised fund and gave away your 10 that year, you put it into the donor advised fund this year in 2025, that would significantly get them above the fact that the accountant should itemize. Maybe they have 75,000 in itemized deductions in 2025. That could save them somewhere between $10,000 and $15,000 on their tax return in 2025. Just some rough numbers I'm throwing out there, but could be a pretty nice tax savings to consider looking at that concept of bunching your charitable donations. And again, I think a lot of times these monies might not be with you. Like maybe it's in their brokerage account or their old computer share stocks and just sitting in cash, right? Things like that. You can get them invested through a Dunman managed account. I would suggest the DC where you're collecting a fee, but it could give them an opportunity to get tax deferred growth on that money. If they wanted to go into a little bit more aggressive model like 60/40 or 80/20.
Yeah, and you really do have to analyze that standard versus itemized to know how much bunching you could do. It'd be really frustrating to go to lengths to do a donor advised fund and only be $2,000 or $3,000 above the standard deduction. Then you really kind of wasted the effort. I mean, now with the enhanced standard deduction and the chance of seniors who make under 125K to get that extra 6,000 per couple, their standard deduction could be in the mid 40s, right? So you'd have to be taking a look at what that is for each couple and maybe bump up that donor advised fund to make sure they're really ahead of standard deduction, right?
Yeah, no, that's a good point, Charles, right? You want to make sure it's advantageous up front. And, we'd be glad to have those conversations. Myself and my counterparts are pretty versed in these, and we could always pull in one of our advanced tax planners to help out with these cases as well. Anybody else? Well, I just want to thank everybody for their time today. Here's my contact information. If anybody, wants to reach out or wants me to send them anything from what we talked about. We have tremendous marketing on all these concepts. So client approved pieces, videos. If anyone wants to see any of those things, again, we can run proposals. So, keep us in mind. I really appreciate, Sebastian and Jody for having me, all the advisors that joined today. I was excited to see such a big turnout. Thank you for that. I appreciate it. Hopefully everybody learned something and we can we can help you raise some more assets.
Hey, Shawn,
Yes, Jim.
I think you should be sharing this with everybody.
Okay. Yeah.
The pictures, I'm a graphic person. The pictures
Yeah.
play
So what
off.
Jim was sharing is that's a brochure on the intermediated installment sale trust, that first concept I talked about. It's a really nice brochure that we have. So yeah, if anyone wants to see that, just shoot me a note. Um, I
And if
didn't
you want
capture
me
all
to, Sean, if you want to get it to me, I can blast it to the group as well after we get it approved by the back office, if you're okay with that.
Oh, that would be amazing, Sebastian. Thank you.
Sure. Anybody else? Questions for Sean?
Great.
No, great presentation, Sean.
Thank you.
I mean, I think you guys can tell, obviously Dunham's managing assets, but Shawn and his team are great resources for advanced planning concepts like you saw today. So you don't get that from every manager out there. I can attest, Shawn had a guy, Sal, in my office last week, and he was also a wealth of knowledge. So they got a deep bench there of people that can help you with these complex cases. And as you said, just reach out or reach out to me, and we can certainly get you in contact with Shawn and his team at Dunham to help out there. But if nobody has any other questions or comments, let's get back to your day. Thanks for joining us today.
Thank you.
Thanks.